let us take the illustration and we'll see that which accounts we are supposed to prepare. So here the illustration is on April 1st, 2004, following balances appeared in the books of Kanishka Traders, where furniture account rupees 50,000, provision for depreciation account 22,000, and on October 1st, 2004, a part of the furniture purchased for rupees 20,000 and on April 2001 was sold for rupees 5,000. On the same day, a new furniture costing rupees 25,000 was purchased. The depreciation was provided at 10% per annum on original cost method of the asset, and no depreciation was charged on the asset in the year of sale. Prepare furniture account and provision for depreciation account for the year ending March 31st, 2005. So let us take first furniture account, where we are going to show the furniture cost and for what cost the particular asset was sold. So there the format remains the same of the ledger account, and the title will be Books of Kanishka Traders Furniture Account, and the format will be date particulars journal folio amount, date particulars journal folio amount. And the asset which was purchased, we are going to show it in the debit side because it is a furniture account where we are going to follow the real account rule. Debit what comes in, credit what goes out. So the furniture was purchased on 1st April 2001. Let us record in the debit side. April 1st, 2001, balance brought down 50,000. Then again additional asset was purchased on October 10th, that we are going to record again. October 10th, bank account in the amount column 25,000. So total asset we have is 75,000 in the debit side, and in the credit side that asset was sold for 5,000, that will be considered here. Bank 1st October, bank 5,000, and then the provision for depreciation was 8,000. So that will be considered again in the credit side. Provision for depreciation 8,000, and then we got a loss on that particular sale which is 7,000. So here profit and loss account in bracket loss on the sale of asset 7,000. Then we are going to close the account here, where the debit side total will be 75,000 and same total will be considered in the credit side 75,000. Then the difference will be 55,000, which will be considered as balance carried down. Now let us prepare the provision for depreciation account, where the format will be date particulars journal folio amount and date particulars journal folio amount, and the title will be provision for depreciation on furniture account. So first thing we are going to take it as brought down here the total depreciation which is given in the question, provision for depreciation account, which is showing 22,000. That will be considered in the credit side. 1st April, balance brought down 22,000. Then again, what are the following depreciation we have charged, that will be considered in the credit side again. 31st March depreciation, where we have 3,000 depreciation and 1,250 depreciation. Total of the both we have 4,250. Then again coming to the debit side, we are going to consider the depreciation which is charged on the asset sold, which is the furniture. So on 1st October, furniture in bracket accumulated depreciation on furniture sold, which is 8,000. Then we are going to close the account. Credit side total we have 26,250. Same total will be considered in the debit side 26,250, and the balance will be 18,250. That will be considered as 31st March. Balance carried down 18,250. Let us take another illustration. If the firm maintains furniture disposal account prepared along with furniture account and provision for depreciation on furniture account. Now we have taken the illustration based on the particular illustration just now we have solved. On particular comparing that particular furniture account here, the asset account will be prepared as, the title will be furniture account and the format remains the same, date particulars amount and date particulars amount. You can add journal folio amount column also. Let us take the format for the furniture account, date particulars journal folio amount and date particulars journal folio amount, where wherever we have purchased the account, that will be considered in the debit side, and wherever we have disposal, that will be considered in the credit side. So here in furniture account, when provision for depreciation account is prepared separately, we are not going to show any depreciation here. Only what we are going to show is what asset is coming inside and what asset is going outside. So first thing, we are going to record the purchase, which will be in the debit side. 1st April 2001, balance brought down 50,000, and another additional purchase where we have on the October 1st, where we have on the October 10, bank 25,000. So the total asset we have 75,000, and the set sold is for 20,000, and it will be showed as 1st April furniture disposal 20,000. Then account will be closed here. 75,000 total of debit side, same in the credit side. Then 55,000 will be considered as balance carried down on 31st March, which means that total asset we have 75,000, 20,000 worth of asset is sold, and the leftover asset in the organization is 55,000. Then coming to provision for depreciation account, we are going to prepare this for charging the depreciation. So where the total depreciation balance was given in the question, which is 22,000, that will be considered in the credit side. April 1st, balance brought down 22,000. Then asset was disposed, on that we charge the depreciation of 8,000, that we are going to consider in the debit side. October 1st, furniture disposal, and the amount will be 8,000. Then we are going to close the account here, where the total of the debit side will be considered in the credit side. Before that, we have another depreciation where we charge 4,250, that will be considered again in the credit side. 31st March depreciation 4,250. Then we are going to close the account. Credit side total will be 22,000 plus 4,250, 26,250. Same total in the debit side, 26,250. Then minus 8,000, the balance will be 18,250. And next we are going to prepare furniture disposal account. So where again it is a ledger account, format remains the same, date particulars journal folio amount and date particulars journal folio amount. Where the disposed account, the furniture value was 20,000, that will be considered in the debit side. 1st October 2004, furniture 20,000. Then in the opposite side, we are going to show that on what is the cost we have considered for depreciation, what is the sale price, and what is the loss. So coming to credit side, first we are going to show the depreciation, where provision for depreciation 8,000, then we will be having sale price, bank where we have sold for 5,000, and the difference will be loss. So asset was purchased for 20,000 and the depreciation was 8,000 and the sale price was 5,000. So the total value we are getting is 13,000, and the 7,000 what we have, it is a loss. So in the credit side, profit and loss, in the bracket loss on sale of asset 7,000. Then both the side will be having the total 20,000 and 20,000. Now let us take another illustration and we'll see that what is the illustration and what accounts we are supposed to prepare. So here on Jan 1st 2001, Jain and Son purchased a second hand plant costing rupees 2 lakhs and spent 10,000 on its overhauling. It also spent rupees 5,000 on transportation and installation of the plant. It was decided to provide for depreciation at 20% on written down value method. So here the asset was purchased for rupees 2 lakhs and 10,000 for overhauling and 5,000 was spent for transportation. So total cost of the asset will be 2,15,000. And the plant was destroyed by fire on July 31st 2004, and an insurance claim of rupees 50,000 was admitted by the insurance company. And what they are saying here, the plant was destroyed by fire on the July 31st 2004, which is where we are getting a claim of 50,000 from the insurance company. So by this information we have to prepare plant account, accumulated depreciation account and plant disposal account, assuming that the company closes its books on December 31st every year. They are following calendar year here, where opening will be Jan and the closing will be December. So now let us prepare a plant account. So let me repeat once again, whenever we are preparing a provision for depreciation account, we are not going to show the depreciation in plant account. So now let us prepare plant account in the books of Jane and Son, and the format will be date particulars journal folio amount and date particulars journal folio amount. So where the first purchase will be recorded in the debit side and we will be carrying the same for the 4 years. So coming to the debit side, 1st Jan 2001, bank 2,15,000, and the same will be considered for the next year, where we are going to consider the total of debit side 2,15,000, same in the credit side 2,15,000, and the balance will be on the closing date 31st December 2001, balance carried down 2,15,000, and the same will be considered for the next year in the debit side after the total 1st Jan 2002, where balance brought down 2,15,000. Then again same total will be closed 2,15,000, 2,15,000 both the side. Then above the total credit side, by balance carried down again on the 31st December 2002, and it will be same considered for the next year 1st Jan 2003, balance brought down 2,15,000. Again third year we are going to close the account, same total both the side, then again same value balance carried on and balance brought down for the 4th year. So coming to 4th year, the opening date will be 1st Jan 2004, again balance brought down and the total will be 2,15,000, and same will be considered in the opposite side, same total 2,15,000, then again balance carried down 2,15,000. So this is what plant account, where all the 4 years we are going to show the same value 2,15,000, and it was not considered, we are not considering the depreciation or the disposal in the plant account. Now let us prepare the accumulated depreciation account, where the format remains the same again, date particulars journal folio amount and date particulars journal folio amount. So first depreciation we are going to charge in the credit side, and the later on the depreciations will be added to the year by year. So now when coming to the depreciation here, in question it is specified that depreciation is charged on written down value method, which means that year after year asset value will be keep on decreasing and even the depreciation value will be reduced. So now first year depreciation will be charged on 31st December 2001. So let us take in the credit side 31st December 2001 depreciation. So total cost of the asset is 2,15,000 and the rate of depreciation is 20%. 2,15,000 into 20% will give us 43,000. So that will be considered in the amount column 43,000. Then we are going to close this particular year. Total of the credit side 43,000, same total in the debit side 43,000. Then above that on the same date 31st December 2001, balance carried down 43,000. Same balance will be considered for the next year again in the credit side 31st December 2002, balance brought down 43,000. And again we are going to charge the depreciation on the cost, where 2,15,000 minus 43,000 into 20%, where we will be getting 34,400. So again in the credit side on the same date 31st December 2002, depreciation 34,400. Then second year will be closed 34,400 plus 43,000 will be getting 77,400. Same total will be considered in the debit side 77,400, and the difference will be the whole amount 77,400 above the total, balance brought down, above the total, balance carried down. Then again for the third year in the credit side 31st December 2003, balance brought down 77,400. Now again coming to the third year, again we are supposed to charge the depreciation on the reduced balance. So where again depreciation will be charged on the same date 31st December 2003, depreciation, and how we are going to calculate the amount here, 2,15,000 minus 2 years depreciation, which is 77,400. So let me repeat, 2,15,000 minus 77,400 into 20%, where the depreciation value will be 27,520. So that will be considered here credit side 27,520 depreciation. Then again third year will be closed. Total of the credit side 77,400 plus 27,520 and the total will be 1,04,920. Same total will be considered in the debit side 1,04,920. Then again same value above the total, balance carried down on the same date 31st December 2003, balance carried down 1,04,920. Again for the fourth year, again in the credit side 31st December 2004, balance brought down 1,04,920. Again coming to the fourth year, we are supposed to charge the depreciation on the reduced balance of the asset. So where how it will be calculated here, again 2,15,000 is the original cost minus 3 years depreciation, which is 1,04,920 into 20%. So let me repeat, 2,15,000 minus 1,04,920 into 20%, where we will be getting 12,843. So that will be considered in the credit side on the closing date 31st December 2004, depreciation 12,843. So again we are going to close the account here. Same total will be considered in the debit side. So total of the credit side is 1,04,920 plus 12,843 and the total will be 1,17,763 and the same will be considered in the debit side in the same line 1,17,763 and the difference will be the same value 1,17,763. Hence it is a last year, the balance will be considered as plant disposal. Again on the same date 31st December 2004, plant disposal 1,17,763. Then let us prepare a plant disposal account where we are going to dispose the asset. So now format remains the same, date particulars journal folio amount and date particulars journal folio amount. So where the plant original cost will be considered in the debit side July 31st 2004 and the entry will be plant and in the amount column 2,15,000. In the credit side we are going to show the depreciation and what is the cost we have received from the insurance company and difference will be profit or loss. So let us take first depreciation, the total depreciation what we have charged in the previous table. 31st December 2004 accumulated depreciation account. So the value will be 1,17,763. So the total depreciation for 4 years under written down value method. And next entry we are going to record for the claim which we have received from the insurance company on the same date. Insurance company 50,000. So now the total depreciation was 1,17,763 and we received a claim of 50,000 and difference will be a loss or profit. So here what is the value of asset? It is 2,15,000 and the accumulated depreciation and the insurance claim what we have received is less than the asset value, the difference will be loss. So let us see the what is the difference here. 2,15,000 in the debit side, same total we are going to take in the credit side, 2,15,000 minus 1,17,763 and 50,000. So the difference will be 47,237, which will be profit and loss in the bracket loss on sale of asset.